Welcome again to Fryer Financial's Financial Forum. I'm Marcus Fryer, certified financial planner, here with Jeffrey Campbell, financial advisor and sports and entertainment wealth accredited management advisor with our firm, who also heads up our sports division. So if you've got those NIL kids out there, get them on over here because we're seeing some
hmm
interesting stuff in the marketplace. So today, if you're looking for clarity and confidence in your financial decisions, you're in the right place. Each episode, we break down last week's markets in motion, unpack the headlines that matters in our segment called Finance in Focus, and then we simplify one key planning topic in our Wealth Wisdom workshop. So let's dive in and make your money decisions clearer, smarter, and more intentional. I'll turn it over to Jeff to discuss markets in motion.
Thank you, Marcus. So, welcome back to Markets in Motion, where we break down what happened in the markets last week in a way that's clear, calm, and easy for you to follow. So, let's jump right in. Last week was a little bumpy for U.S. stocks, but nothing dramatic. The S&P 500 slipped just under half a percent. The Nasdaq fell a little bit more, so about 2/3%, and the Dow dipped just under third of a percent. But here's the interesting part. International markets actually had a very good week, with the developed markets index rising more than 1%. So while the US stock took a small step back, global markets moved forward. So this week really felt like a series of waves, up, down, and back again. And that was thanks to a mix of government news, inflation updates, and company earnings. First, things started off a little shaky. News broke that Justice Department is investigating Federal Reserve Chair Jerome Powell. That caught investors off guard and pushed markets lower earlier in the week. Then central bankers around the world stepped in with a joint statement to calm things down, and that helped steady the market a little bit. Next, the White House suggested a temporary 10% cap on credit card interest rates. That put pressure on the financial stocks because it could cut into bank profits. But we also got some good news in the market. So inflation came in right where economists expected. The more important core inflation number was actually cooler than expected. That helped ease some nerves. Later in the week, strong retail sales and wholesale inflation reports showed the economy is still holding up well, with geopolitical tensions and weak earnings from a few big financial companies pulled the market down again on Wednesday. So overall, it was a week full of headlines, and the market reacted to each one. So if we look at the bigger picture, international stocks have been strong over the past month. Nasdaq and S&P 500 continue to shine over the past year, and over the last 5 years, the S&P 500 is still the top performer. So short-term leadership is shifting, but long-term trends still remain steady. And if you look at the S&P 500 chart from January 12th through January 16th, you'll see exactly how the week played out. Monday and Tuesday were mostly steady. Wednesday, we saw a noticeable drop, and that was a reaction to the Powell investigation and the weak financial earnings. And then Thursday and Friday brought a partial rebound as investors digested the inflation data and regained some confidence. So it was a classic dip and recover pattern, and a reminder that the markets can wobble without losing their footing completely. So, as we look into what's coming this week, we've got a busy week ahead with several important economic reports. Wednesday, construction spending and pending home sales. Thursday, jobless claims and an updated look at the GDP and the PCE inflation report. Friday, we have a consumer sentiment and new readings on manufacturing and services. And it's always a big week for earnings. So Tuesday, Netflix, Interactive Brokers, and U.S. Bancorp. Wednesday, we got Johnson & Johnson, Schwab, and Prologis. Thursday, we got Procter & Gamble, GE Aerospace, Intel, Abbott, Intuitive Surgical, and Capital One, and plenty of information for investors to digest as we kind of get to some of those earnings reports. So here's the bottom line. The market dipped slightly, but nothing alarming. Big headlines caused short-term swings, but investors stayed mostly steady. Inflation is cooling, which is helpful. International markets outperformed the U.S. last week. And this week brings a full slate of economic data and earnings reports. So that's your Markets in Motion update for the weeks. Thanks for joining us as always, and we'll keep watching the market so you don't have to. Now back to markets for our Finance in Focus section.
Thanks, Jeff. Gosh, a lot going on this week in the markets and every week, as always. So let's get into Finance in Focus. So let me get these slides up as well here. Let me share my screen. All right. So first, we're going to talk about consumer sentiment. Consumer sentiment isn't just low; it's kind of what we'll call fractured. As you'll see in Exhibit 7 on the screen, that shows the overall U.S. consumer confidence as measured by the University of Michigan has plunged to levels we've not seen since the early 90s. Recessionary dips are expected, but the post 2022 collapse stands out for its depth of those feelings. Exhibit 8 then reveals something even more troubling. Sentiment isn't just falling evenly. Lower income households, meaning the bottom third, consistently report the weakest outlook, and the gap between the income groups has widened. While higher income consumers have rebounded modestly, those with fewer resources remain pretty pessimistic. And this divergence matters because consumer sentiment drives spending, right? When optimism is concentrated at the top of our wealth, the recovery risk becomes kind of lopsided, because we rely on the bottom third to kind of prop up the economy. So strong in the markets, weak on Main Street is what we call it. So investors and policymakers alike, we're this chart is a reminder that economic data may look stable, but sentiment tells a more human story. And right now, that story is one of caution, inequality, and fragility. Now, as we continue looking on, consumer confidence and spending aren't always in sync either. And this chart proves it again. The blue line tracks the University of Michigan's major purchases index, adjusted for recent survey changes. The white line actually shows real consumer spending on durable goods and autos. On durable goods, I'm sorry, but it excludes automobiles. So what's striking in this divergence? Even as confidence dipped sharply post COVID, as you can see in the slide there, spending remained surprisingly resilient. Consumers kept buying not because they felt secure, but because they felt squeezed. They deferred purchases, then stimulus hit, and then this inflation psychology all played a role in that. But we see cracks are forming as confidence remains subdued and post-pandemic the surge fades, durable goods spending is losing momentum. So this isn't just a data point, it's a warning. When sentiment stays low and spending slows, the consumer engine that drives the US economy kind of begins to sputter. So for investors, this chart is a reminder, don't just watch what the consumers do, listen to how they feel. Confidence leads behavior, and behavior shapes the markets. So for right now, also what's kind of different is stocks are kind of ignoring bonds. So since November, the S&P 500 has surged while the 10-year treasury yield, which is inverted here, has dropped. Historically, these two things move in tandem, but falling yields often signal economic caution, and stocks typically respond in kind, but not this time. So this divergence suggests that investors are betting on a very soft landing, and we'll talk about that a little bit later, or they're just simply chasing momentum in the market. Equity markets are pricing in rate cuts, resilient earnings, and AI-fueled optimism. Bond markets, meanwhile, are flashing caution, slower growth, tighter credit, and lingering inflation risk. So the key is going to be who's right. That's the $1 trillion question. If bond yields are falling for the right reasons, because it's easing inflation and dovish, then stocks may be justified. But if yields reflect deeper economic stress, this rally could be running on fumes. So for portfolio strategy, this chart is a reminder when markets decouple, i.e., we've got financial markets from different countries going in different directions, risk management matters more than ever. Diversify, discipline, and be clear on your purpose, and that's going to give you an edge. And we're also seeing that global rebalancing is beginning. So for decades, U.S. equities have outperformed, but history suggests that dominance does not last forever. This chart shows that the relative performance of U.S. stocks versus the global markets, highlighting three major peaks: the Nifty 50 bubble in the 70s, the dot-com surge in 2000, and now the Magnificent Seven. Each peak was followed by a reversion, not because the U.S. lost its edge, but because valuations were stretched, global growth rotated, and capital sought balance. Today's peak is the highest yet, as you can see, driven by AI optimism, tech concentration, and dollar strength. But we are starting to see cracks forming. Rising geopolitical risk, shifting supply chains, and central bank diversification are all nudging capital outward. So global rebalancing isn't a prediction, it's a pattern. And for investors on legacy and resilience, it's a call to diversify. We've even done so in our portfolios. We normally do not invest overseas, but we're starting to put a little bit of money overseas. U.S. exceptionalism may persist, but the margin for our error is shrinking. This chart isn't just about performance, it's about perspective. And right now, the world is starting to matter again. Now, here's some good news: the return of real assets, gold. Gold isn't just outperforming, it's being redefined. Over the past 4 years, it has quietly outpaced U.S. equities, echoing historical moments when trust in fiat systems wavered. From the Great Depression to stagflation, from global realignments to today's popular surge, gold has consistently stepped forward when confidence steps back. Now, central banks are even making that shift. The share of gold in total reserves is climbing fast, projected to hit nearly 30%, as you can see in this graph, by the end of 2025, leading into 2026. So, this isn't speculative, it's a strategic repositioning, a vote of caution, a hedge against political risk, current volatility, and the fragility in the system. Together, and here's another chart, these charts tell a story of quiet rebellion. Institutions are signaling that the monetary order is evolving. Investors are discovering the value of permanence, neutrality, and resilience. So, for legacy driven portfolios, this isn't just about performance, it's about positioning, and gold is no longer just a hedge. Politics, of course, Jeff previously mentioned the race for the Fed chair is heating up, and not just because of monetary policy. An investigation into Jerome Powell has complicated his reappointment with President Trump, reportedly favoring a loyalist while senators push for independence. The Fed's credibility is obviously on the line, just as officials signal a pause in rate moves amid stabilizing labor data and stubborn inflation. Behind the scenes, Fed researchers are wrestling with deeper tensions: how to sink the balance sheet. Shrink the balance sheet without triggering volatility or overstepping intervention. It's kind of a delicate dance, and the outcome could reshape how central banks operate for years. Meanwhile, Wall Street is just roaring. Bank CEOs are bullish on mergers and acquisition. Capital markets are after a record $134 billion in trading revenue last year. Shareholder rewards are flowing too, with $140 billion in dividends and buybacks, topping pre-pandemic highs. And Jeff mentioned corporate news earlier. Netflix expands its Sony deal. Verizon secures its $9.6 billion Frontier acquisition. China clamps down on high-speed trading, among other things. And taken together, the week's headlines reflect kind of a world in flux. We got central bank independence, financial sector, geopolitical things going on with Greenland and all this fun stuff. So get ready for a bumpy ride, people. So now we are going to pivot into this week's Wealth Wisdom Workshop, and our focus is on index funds. So take it away, Jeff.
Yep. So today we're going to step back from the week-to-week market noise to talk about one of the most powerful tools in long-term investing, index funds. So whether you're a seasoned investor or just getting started, understanding how these funds work and the major indexes they track can help you build a portfolio that's diversified, cost-efficient, and aligned with your goals, which is extremely important. So what is an index fund? An index fund is a type of investment fund, either a mutual fund or an ETF, and it's designed to track the performance of a specific market index. Instead of trying to pick the winners or time the market, index funds allow a simple rule: own everything in the index in the same proportions as the index. So that means lower costs, broad diversification, less guesswork, and historically competitive long-term performance. Now let's walk through these major types of indexes investors rely on and the most popular funds in each category. So let's start with the S&P 500, and that's the core of many portfolios today. The S&P 500 tracks 500 of the largest U.S. companies, so let's think Apple, Microsoft, Amazon, and the rest of corporate America's heavy hitters. It's often considered a benchmark for the U.S. stock market. Popular S&P 500 index funds would be the Vanguard S&P 500 ETF, so VOO, the SPDR or SPDR S&P 500 ETF Trust, or SPY, is what a lot of people call it. iShares Core S&P 500 ETF, or IVV. These funds are staples for investors who want broad exposure to large cap U.S. companies. So then we would go into total stock market funds, and these own the entire U.S. market. So if the S&P 500 is the heart of the market, total market funds are the whole circulatory system. These funds track thousands of companies, large, mid, and small, and microcap. So some popular ones in that are the Vanguard Total Stock Market ETF (VTI), Schwab U.S. Broad Market ETF (SCHB), iShares Core S&P Total U.S. Market ETF (ITOT). Those are great for investors who want maximum diversification in a single fund. And so then we go into the growth and technology indexes. Those are the engines of innovation. Growth and tech indexes focus on companies expanding rapidly, often reinvesting in profits into innovation rather than paying dividends. These funds tend to be more volatile but offer higher long-term growth potential. Some popular growth and tech funds would be the Invesco QQQ Trust (QQQ), and those track the Nasdaq 100. The Vanguard Growth ETF (VUG) tracks the large cap growth stocks, and then the Technology Select Sector SPDR Fund XLK, and that's pure tech exposure. So these funds tilt towards companies that are shaping the future. So we get like companies such as cloud computing, AI, semiconductors, and more. The ones that are shaping the future as we know it. And then we go into the small cap index funds, the market's up and comers. The small cap companies are the scrappy, fast growing players of the market. They're more volatile, but historically, they've offered strong long term returns. So some popular small cap funds are the iShares Russell 2000 ETF, IWM, and that tracks the Russell 2000. The Vanguard Small Cap ETF, VB, and then the Schwab US Small Cap ETF, SCHH. Those funds give investors exposure to the next generation of potential market leaders. And now we've gone over a lot of global ones. We're going into the international index funds. So that's when you want to diversify past the U.S. borders. International funds help investors spread risk globally, and they capture growth in the developed and emerging markets. Some popular international funds would be the Vanguard FTSE Developed Markets ETF, VEA. That includes Europe, Japan, and Australia. The iShares Core MSCI EAFE ETF. That's the developed markets, and you've heard us mention that a couple of times now in our market update. Then we have the Vanguard FTSE Emerging Markets ETF, the VWO, and that's the China, India, Brazil, and more. Those funds have balanced a portfolio that might otherwise be too U.S. centric. Now I'll turn it back over to Marcus to analyze index funds in your portfolio.
Yeah, thanks, Jeff, for breaking that down for us on how those index funds work and some of the more popular ones that we kind of see in the marketplace. We typically only use SPY in our portfolios and just at a small percentage. And as we go through the use of index funds, you'll kind of see why that is the case. So, what are some of the advantages of index funds? Well, of course, they have extremely low cost. So, since index funds are passively managed, meaning they simply replicate an index rather than pay a analyst to pick stocks, there's not a lot of cost to them. So often they're charging, 1%, 0.1% or less. And fee drag on a portfolio can, really bring down its performance. They offer broad automatic diversification because you're buying the index. So you're buying a bunch of stocks versus having to kind of pick and choose them on your own. They also offer quite a bit of diversification, which is kind of a core risk management tool, but they also have some issues too, which we'll talk about. They also offer market matching returns because you're investing in that index, so you're getting that market and that market performance. They offer tax efficiency because they're not traded very much, so you're able to manage those taxes as well. And they're pretty simple at the end of the day. Nothing to analyze. You buy the index and follow it. What are some of the drawbacks though of index funds? So one, there is no ability to outperform the index. You're in the index, so you can't really outperform it. So they can't take advantage of things that are mispriced and some of the securities and market inefficiencies that take place. So if you're looking for alpha trying to beat an index, you're going to have to go somewhere else other than a index fund. Limited growth potential in certain market environments. So because you're in an index fund, sometimes these funds are overweighted towards the largest companies. So it's kind of skewing the performance. And in certain markets, you may underperform. And in certain market conditions, you may actually underperform what's going on. So that becomes key. Limited flexibility. I mean, you're in an index, so you're not trading positions, so that limits your ability, and also some of your risk can become a little bit concentrated when they overweight those indexes towards those top companies. Now here's where this is the part that we just love. So systematic risk cannot be avoided. You can kind of diversify away some of the company specific risk, but you can't get rid of that systematic risk or that market risk. That index is going to follow that market. And we're going to see that in action here in just a second. And that's the problem with the index funds. It's from a risk management standpoint, is because you can't, they have no guardrails on them. So when you slide down the market, you slide all the way down. And so versus us kind of telling you that, we're actually getting ready to show it to you. So hold tight. Let me pull up this screen. Okay. So here, let's see, let's let that get over. Okay, great. So here you can see, as we mentioned, Spider S&P 500 ETF Trust here. Let's see if I can get this at its, we'll just go back at its height early last year. Looks like it was about February 19th or so. Oh, hold on. Let me go back. Sorry. All right, here we go. Let's go back a year. Okay. About February 19th, 612.93. All right. So if you're in the market, you're riding this index fund, and you'll see it slid all the way down to 8 in April, on April 8th. That's quite a ride. And I'll show you that in percentages. And now we're back up to 691 here. So let's take a look at what that meant economically if you kind of slid all the way down this this index fund. So I have another chart to show you. Okay, so let's imagine we're an investor and we have $250,000. So February 15th, 2025, that index was 612.93 per unit, and it slid all the way down, as we saw, to April 8th. That was a 18.9% loss. So your portfolio slid from 250, lost $47,000, slid all the way down to 202. And now once you put the recovery on of 39%, so that's the change from the bottom, the 496.48, up to yesterday, 691.16, that's been a 39% gain. So that's, most people like that. Okay, I slid 18 down, came back up 39. So now I'm sitting at 281. All right, great. Now, here's kind of what happened with most of our clients. So we knew the tariff wars were coming. So we started positioning client portfolios December and before the inauguration. So in April, when I'm getting phone calls, or Jeff and I are getting phone calls, they're like, hey, Marcus, I see, gosh, the market's down 10, 12, 15, 18. What am I down? I rounded this up to 2%, and we weren't down 2%. The reason I did 2, just to kind of overemphasize, even with our advisor fee, which would have been 0.25%, 0.25% each quarter. And so I'm rounding that up. We were only down 1%, but I'm rounding it up to 2 just to be overly kind of illustrating advisor fees at their worst. So we're only down 2%. Portfolio's down 2% after paying the advisor. So that's $5,000. So our clients only went down to 245. Now, and we waited because we're not going to jump back in. We're risk managers first. So even if we jump back in late in the game on this 496 April 8th coming back up, and we only capture 20%, our clients ahead at 294. If we capture 25% of that 39, our client's still ahead of this person at 306. If we captured 30% of that gain, our client is way ahead at 318. So that's why we kind of lead with risk management, because it's all about managing the risk. It's not what you gain, it's what you don't lose that makes this portfolio perform. So what we're able to do is kind of sit on the sideline, and I'm not even actually adding in the income we took during this slide, because we put some strategies around these portfolios that actually gained our people income. So we're just saying we lost, 2%. So our clients are coming out way ahead. I mean, this person is $13,000 ahead. This person is $25,000 ahead, and this person is $37,000 ahead. So even at our minimum, we're we're ahead by $1,000. So, we hear a lot in the marketplace, just throw it in the index fund. You don't need an advisor. Why pay them that 1% fee? This is why you pay advisors a 1% fee. because we can easily outperform the index with just risk management techniques. So that's how we beat the index. All right. So at this point, we've kind of given that illustration of how that works, the risk management piece. And what we're talking about here is, again, take a moment to understand why this matters. Sequence of return risk, especially for retirees, this matters because a retiree cannot afford that $47,000 loss. How are we going to replace that income? They can't. We got to get on the sideline. So make sure if you want personalized risk management, portfolios that benefit from factors and tilts and overlays, this is what advisors do. This is where our separately managed account driven approach outperforms. So your index funds can provide the foundation, but your SMAs, your separately managed accounts, provide that precision. All right. So this is a perfect dovetail into next week's topic. So next week's topic is going to be SMAs, separately managed accounts versus model portfolios. So Jeff is going to take it away to kind of give you the overview of what we're going to be talking about next week and in next week's session.
And that was some great information right there, Marcus. I hope everybody was listening. And so, like Marcus said, next week we'll compare and contrast separately managed accounts versus model portfolios. Model portfolios are efficient, scalable strategies for broad goals, but lack event-driven management, whereas SMAs are specifically designed to you and your goals, focusing not only on your risk tolerance, but also your risk capacity. Also kind of touching on what Marcus just went over. In this matter, SMAs provide precise risk management. We believe every client should have a separately managed account that provides the control, personalization, and risk management required to comfortably reach your goals. And so, with that being said, thank you for joining us on today's episode of Friars Financial Forum. I hope you're leaving with more clarity, more confidence, and a deeper sense of purpose in your financial journey. If you found today's conversation helpful, be sure to follow the show, share it with someone who might benefit, and leave a review. It helps more people discover the clarity they've been looking for. And reminder, financial success isn't about predicting the future. It's about preparing for it with intention, discipline, and a plan that aligns with your life and your values. As always, I'm Jeffrey Campbell, and he's Marcus Fryer. And thanks for watching, and we'll see you all next week.
Thanks, everyone. Have a great week.